Most traders learn this lesson the hard way. Shorting a major stock index like the Nasdaq sounds logical, but in practice, it's one of the hardest trades in the markets. And it's not because traders are stupid, it's because the market has structural headwinds that punish persistent shorts. Let me explain why. First, stock indices have something built into them that most traders underestimate: upward drift. Equities exist to grow. Companies reinvest profits, expand, innovate, and buy back shares. Investors demand a premium for taking equity risk, and that premium creates a long-term tailwind. When you short an index, you're not just betting against price, you're betting against decades of capital accumulation. That alone makes shorting difficult, but it goes deeper than that. Indices like the Nasdaq aren't static baskets of companies. They are regularly reconstituted. Companies that no longer meet eligibility or size criteria drop out, and the index refreshes into larger names over time. The effect is that the index maintains exposure to winners even as individual stocks fail. So when you short the index, you're effectively shorting a portfolio that continually adapts. Another problem is concentration. The Nasdaq is often driven by a small number of mega cap stocks. When those leaders rally because of earnings, liquidity conditions, dominant themes like technology adoption, or large buyback programs, the entire index can rise even if most stocks are flat. Shorts get squeezed not because the economy is booming, but because the heaviest weights are moving. Then there's the asymmetry of shorting. When you go long, the worst case scenario is losing what you invested. When you go short, your upside is capped, but your downside isn't. Markets can rise far longer than expected, and losses can exceed initial capital through margin mechanics. This asymmetry is why professional traders treat short exposure very differently from long exposure, and psychologically, shorts are brutal. Markets rarely crash straight down. More often, they grind higher and then accelerate upward on good news, inflation data, central bank signals, earnings beats. Shorts are forced to cover into strength, which adds fuel to the move. That's how so-called crash-ups happen. This dynamic also explains why inverse index products can surprise people. Most inverse and leveraged inverse ETFs reset daily. Over time, volatility and compounding can cause performance to diverge significantly from what many expect, particularly in choppy markets. They can be useful tactically, but they are not designed as long-term shorting tools. So if shorting indices is so difficult, how do professionals actually do it? The key is understanding that shorting is not the same as hedging, and that risk must always be defined. One common institutional approach is futures. Selling index futures provides direct exposure, tight spreads, and efficient execution. But there's no built-in protection. Risk must be managed actively, position sizing must be disciplined, and invalidation levels must be clear. Futures are typically used for short-term, high-conviction trades tied to specific catalysts. Another widely used approach is options. Buying puts or put spreads defines maximum loss up front. You're not fighting unlimited upside, you're purchasing downside convexity. This is why options are commonly used to hedge portfolios or to position for sharp drawdowns without risking catastrophic losses. But here's the most important part, the part most people skip. You need the right reason to be short. Valuation alone is the weakest reason. Markets can stay expensive for far longer than most expect. The strongest index shorts usually combine three elements: a macro regime shift, such as tightening liquidity or falling earnings, crowded positioning, where risk is one-sided, and technical confirmation, where price actually supports the thesis. Without that combination, shorting often becomes a slow bleed. And finally, Risk control is non-negotiable. Short smaller than you think you should. Define exactly where you're wrong before you enter. Avoid averaging into strength without a clear catalyst. And always be aware of events that can gap the market against you. Shorting indices isn't impossible, but it is a specialist tool, not a default strategy. If you treat it casually, the market will punish you. If you respect the structure, define risk, and wait for the right conditions, then it can become one of the most powerful tools in your trading arsenal. And that's the difference between traders who blow up and traders who survive long enough to compound